Here's Al in Ottawa. Go ahead, Al.
Good evening, guys. My question for David is on mortgage REITs in general on the New York Exchange, and in particular Annaly Capital Corporation, NLY New York, which I've probably seen recommended 10, 15 times in the last month. I'd appreciate David's comments on it. Thank you.
Sure. Al, Annaly Capital Management is a company that invests in mortgages on a leverage basis. They raise capital and then they go out and build a portfolio. It tends to do well in a falling interest rate environment. It pays a very big yield. The yield's about 15%.
Yeah.
And which sounds very good. I have owned Annaly in the past. We don't own it currently. And one of the only reasons we don't own it is that you know, there has been lots of talk about trying to force the mechanism for refinancing for American homeowners. That could have a negative impact on the mortgage REITs if it sped up some of the refinancing. So that is a risk. You'll notice if you look at the chart over the last couple of weeks, there's been more volatility than there has been historically in the stock. and so, you know, that's an issue out there. It's a good yield vehicle. You know, there obviously are risks. Rising rates are a bit of a risk there at some point. But this is a very, very well-run mortgage REIT, probably the best-run mortgage REIT. And so if you can assess some of those risks, it's something you could own as part of a portfolio.
Let's shift gears. We'll talk to Lisa, who is in Toronto. Good evening.
Hi, thank you for taking my call. Mr. Burrows, I'd like to ask you again about, I've checked with you before about Canfor Pulp. I've been holding the stock. I bought it in two stages, first around the $15 mark and a little over 17. I've noticed that lately it's been coming down. Since I'd like very much to hear what you think about the stock. Should I continue to hold it? Is it due to market volatility, or is the sector out of favor, and should I not hold it anymore? I'll hang up and listen. Thank you for your answer.
Thanks, Lisa.
So, Lisa, Canfor Pulp is a security that we've held for quite some time in our portfolios. Pulp prices have been very strong. And the distributions in this one have been very, very good. So the indicated yield's around 10% currently. We believe that the distribution is safe. Pulp prices have held up very well. But that being said, when you look at what's been going on in equities over the course of this summer, one of the big fears is that the weakness in the overall economy washes through some of the more economically sensitive companies. And Canfor Pulp, you know, does have some economic sensitivity. And at this point, pulp prices are holding up, but the market has probably added an additional risk premium in the event that the economy does slow to the point where pricing starts to back off. So at this point, we think that the distribution is safe. We continue to own it. It has pulled back a couple of bucks. So if you have a belief that the economy will roll over and double-dip recession, then this is one you'd want to be a little bit careful of. I would say there should be some support around $14, and you might use something just below that, call it $13.75 as a stop, and pick your spot as to where to exit. But in the meantime, you know, I think that you're going to continue to get paid.
Do you know what your average cost is on this one? Because it's had such a run since the market bottom.
You know, we've bought it at multiple prices. It tends to be when we make an initial investment, we only add to positions as they're working. And so we've built this position over quite a long time. We've bought it at multiple prices.
All right, here is Joan, who's in Montreal. Go ahead.
Yes, good evening, gentlemen. It's a pleasure to speak to Mr. Burrows because he made me a profit. I sold my Hess Corporation in March of 2011 at $85.50, and I had bought it in July '09. I made a profit in my RIF account. That was another thing you don't often mention. It is much better to make any capital gain in your RIF account. Now, it's come right down again. Today it was precisely 59.66. Do you think it'll go up again, Mr. Burrows, or do you think I'd just leave that alone?
Well, you know, our view is that the integrated oil and gas companies are under a little bit of pressure. I would prefer, if you're going to own an energy equity, either a pure producer that is having good success with the drill bit, And in the U.S., I'd get you to take a look at a company like St. Mary's Exploration, SM, in New York. They've had tremendous success and are building great value in the business. Or look at one of the income-producing equities in the Canadian market, and there's a number of them. The integrateds at this point I would stay away from. Now we'll see what happens as we come through into the fall. If markets start to firm up a bit and the energy stocks start to behave a little bit better, but in the short run, it's a group I'd stay away from.
I haven't heard of this St. Mary's SM in New York. Why do you like them?
Well, they've had tremendous success with the drill bit. This is a $5 billion company. Most recent quarter, they beat by 66%. They have some assets that they could sell. They've been able to finance their growth through cash flow. And there are a number of mid-sized energy producers in the U.S. that have had some real success, and this is one of them.
And that's quite a chart there over 1 year, and this was a $12 stock back in March 09 and has climbed steadily to where it is now, $75.41, and even peaked out at over $80. All right, there's a off the beaten track recommendation from David. We will take a short break here, and we are going to come back with his past picks. We're looking at September 28th of last year. He's got three interesting choices here. He's no longer holding any of them, and we'll find out why right after this.